Well, here in Spain, Cathal Rochford returns to the studio this week. How are you doing?
Yeah, I'm keeping very well, Howard. It's good to be back with you, and I'm glad that the summer's coming to an end. It's been quite a hot summer here in Mallorca.
Yes, we're into September, which is always a nice month.
Absolutely.
Well, this week we're looking at interest rates in the UK and Spain. Rates have been falling, and that's had a big impact, especially on those who rely on savings income. So, Cathal, let's get straight into it. What's happening with interest rates right now?
Yes, so we are seeing a broad-based and consensus trend of global central banks reducing interest rates across the world, and it'll likely continue for some time. The vast majority of central banks globally are reducing interest rates, with some exceptions like the likes of Japan, who hadn't actually raised interest rates in recent years. So we've seen the likes of the ECB cut interest rates 8 times since June of last year. The Central Bank of England has cut interest rates 5 times since August last year. And even the US Federal Reserve, the central bank in the US, has cut interest rates 3 times since September of last year, with another rate cut priced in this month. The reason being is that interest rates were increased at the fastest pace in history after the inflationary shock after COVID. And now, as inflation has decelerated and is stabilizing somewhat, central banks are bringing interest rates back down to more neutral levels. So we're in a world with very high debt levels, and this will also offer some relief on reducing interest payments and allowing refinancing of debt at more affordable levels. So it's generally seen as a positive development for economic activity and global growth.
Are there risks, though, for retirees who rely heavily on income from cash deposits?
Yes, as I mentioned, lower interest rates is a good thing for borrowers, like people financing their businesses, taking out a mortgage to buy a home, etc. As the cost of money is cheaper and generally more abundant, savers are actually at a disadvantage as the money they receive as interest on their bank deposits falls in line with interest rates. For example, for somebody living in the UK, in say mid last year, they could likely have received an interest rate of around 5% on their cash. Today, that rate is 4%. So let's say someone has £1 million in the bank. Their income or their interest on their cash has fallen from £50,000 per annum to £40,000 per annum over that year. And if interest rates continue to fall further to say 2%, their interest rate will have fallen, or their interest income will have fallen from £50,000 per year to £20,000 per year, which is actually a 60% pay cut. So it's not ideal if one relies on this income to cover their fixed living expenditures. And this is where, one needs to consider a strategy that can provide sustainable income in the event of low interest rates. And we need to remember that interest rates in the UK were close to zero from 2009 to 2020. So really holding cash and relying on interest is not really a strategic long-term solution for one's capital.
What about premium bonds? Are they worth holding?
I would say it depends on your objectives and your own situation. For a Spanish resident, as most of our listeners are, premium bonds don't offer any tax advantage, and the interest paid is fully taxable here in Spain, unlike for UK tax residents. Secondly, if we look at the average interest rate paid on premium bonds over the last, say, 20 years, they have averaged close to around 2%. And this is before Spanish taxes would be applied. So this is likely a lower rate of annual return than the increase in the cost of living each year. So I would say as an investment asset for someone living here in Spain, they're not really worth holding, and there are alternatives that can greatly outperform premium bonds.
But how can we protect our savings income in a low-rate environment?
Yeah, so as I mentioned, falling interest rates are a net positive for economies and capital markets. And as interest rates fall, the cost of borrowing or the price of money falls. This means that countries, companies and individuals can access funds more affordably, and it generally leads to increased economic activity, growth, jobs and wealth. For example, if a company can borrow funds more cheaply, they're likely to pay down their debts, invest, create jobs and grow. And this can lead to a rise in stock markets. Property markets also get stimulated with lower interest rates due to cheaper mortgages. And bond prices rise as interest rates fall. They have an inverse relationship. So this means that a diversified investor with exposure to stocks, bonds, real estate will really benefit from from falling interest rates as it leads to higher portfolio values. So while savers tend to lose when interest rates fall, investors usually benefit. So having the right financial planner and the right strategic financial plan in place can ensure that you're the beneficiary of a change like this and increase your wealth and income rather than take a considerable pay cut.
And how can our listeners get in touch with Blevins Franks?
Please have a look on our website, blevinsfranks.com, and you can access all of our material, information, podcasts, books, tax guides. And even better yet, get in touch with one of our local offices. So we've got offices across France, Spain, Portugal, Monaco, Malta, and the UK, and Cyprus. So get in touch with your local office, and we'd be more than happy to have a no obligation chat.
Thank you very much. We'll talk again next week.
Thank you, Howard. I look forward to it.